Good afternoon, everyone, and welcome to this webinar. This is the Economic Outlook 2021 and beyond. I'm Julio Rivas. I am an associate professor of finance, and recently I was appointed director of the MBA program. So if you want to go to grad school, make sure you contact me, and I'll be happy to help. Today we have a very special guest, a very good friend of our College of Business. He is John Weisenseel. And I'm going to read a little bit of his bio. He served as Senior Vice President and Chief Financial Officer for AllianceBernstein LP, global asset management firm. And prior to that, Weisenseel was Senior Vice President and Chief Financial Officer for Standard & Poor's, a subsidiary of McGraw-Hill, from 2007 to 2012, and Senior Vice President and Corporate Treasurer for the McGraw-Hill companies from 2004 to 2007. He also served in financial leadership roles at Citigroup and Barnes & Noble. And I would also like to add that he was part of the team that was involved in the relocation effort of the AllianceBernstein corporate offices from New York City to Nashville. John and I had a very good conversation about that before, and it was a very interesting process. And he's also right now an executive in residence for the College of Business here at Lipscomb. And he will share his experiences and expertise with our students. We also had a conversation to see how can we fit all of his knowledge so that our finance students can learn from people like him that certainly have a lot of experience. So John, welcome to this webinar. Welcome to this little talk that we're gonna have, and it's the economic outlook. So just before we start, I would like to say that might be better if you switch your view to gallery view so that you can see both of us. And there's also a Q&A, so you can ask us questions, and well, we will be happy to try to answer them. We will be allocating time towards the end of the session to answer questions, but feel free to ask, and we'll do our best to get to them whenever, if hopefully, or when we have time. So John, welcome, and it is very good to have you here.
Thank you, Professor Rivas. It's a pleasure to be here with you today and with everybody that's participating. I'm extremely excited to be partnering with the College of Business at Lipscomb and in the Executive in Residence program. Look forward to meeting many of you in the upcoming school year and working with you.
Well, thank you very much. And well, let's get down to business, right? So one of the topics, one of the main concerns that a lot of us have right now, it's inflation. Right? We hear it all over the news, and there's a lot of people that have been asking me, and I assume you and other people that know about these, like inflation. So what can we say about inflation and like the current trends, and if COVID has anything to do with what's going on right now? Should we expect this to be temporary, or should we expect this to stay here for a long time? So what do you think about this, John?
That's a loaded question. We definitely have. We had the consumer price index was released for June earlier this week, and it was up over 5%. It was actually up sequentially from May about 90 basis points, so just under 1 full percentage point, which was the highest month-to-month increase since 2008. So inflation is definitely out there. We're seeing it in terms of robust housing prices, especially here in Nashville. We're seeing increased commodity prices, whether it be copper, coffee, or the energy prices. Lumber actually had hit highs earlier in the spring. It's actually back down lower now, but still a lot of pressure throughout all the commodity prices. And you think about wages. Yesterday, BlackRock, which is the largest asset manager in the world, just announced that they were going to institute 8% increase in their base salaries all across the board at the director level and below. And so you're starting to see things work their way into the wages as well. And I heard earlier this week that there's about 9 million people that are still currently unemployed and looking for work. Yet there's more than that jobs that are open. There's about 9.2 million in jobs that aren't filled. And so, what that's telling us is people are being very selective in terms of going to work, whether they're looking for increased wages. They may have been in the hospitality industry pre-COVID and they were displaced, laid off, and they found other means of earning income and are reluctant to go back, or have to be tempted back with higher wages. So we're seeing, I think, wage pressures, inflation pressures, really all throughout the economy.
Yeah. Now that you mentioned that, it's very simple. I don't know how many of you have been to a restaurant recently, but a lot of them are understaffed. I mean, they cannot hire enough people to work there. And if they want to convince someone to work, they need to pay them higher wages, I guess. And that was also another example I was giving to a lady that was asking me about all this. And restaurants and a bunch of other participants in the economy will have to face a challenge, and that is, okay, should I increase my prices or should I keep my prices low to be competitive, right? However, if you keep your prices low, your cost might be very, very high, and you might not be able to stay in business, right? So that's a tough decision, right? And you were mentioning commodities, right? And commodities change prices every day. I mean, not only every day, every minute, right? Those are very unstable. It's I give this example to my students. Starbucks. You go and get coffee, and you pay us X amount of money for a cup of coffee, but the cost of getting that coffee changes, right? I mean, that's not a constant price. Well, they might do hedging, they might do some strategies to make sure that the price is as constant as possible. But if they change prices to the final customer, well, that's a different story, right? And we're seeing that a lot of companies right now are increasing prices. You mentioned the housing market. I was talking to a friend that he's moving from Houston to Nashville, right? And the housing market is crazy. I mean, it's I don't know if you see any differences from when you moved to Nashville to right now, but home prices are very high. So
They are. Yeah. So I guess the question is, is it transitory or is it permanent? And I think
that's a great question, and that's where I was heading. How can we assess this?
Yeah. No. And look, I think it's at least the Fed thinks it's transitory. I would agree with that. I think the real question though is, how long is transitory? We're trying to order things, but we can't get them. So one of my Alliance Bernstein colleagues actually just recently is buying a condo in Germantown, and the closing now has been delayed for over a month because they can't get the appliances. The appliances are just all back ordered. I'm actually sit on the board of the Nashville Zoo. I have the pleasure of doing that. We had a meeting earlier this week. They actually had to suspend some construction projects for 2 months. Earlier this spring because they couldn't get the steel, they couldn't get the plastics that they needed. So I think it's going to take a while, I think, for this supply chain to work its way out, and that's creating some inflationary pressures as well. So I think we're probably here, a year to a year and a half dealing with this. I don't know if you have a thought on that yourself.
Yeah, it's the supply chain disruption was very tough, and COVID. Well, I would say COVID is to blame for some of this. It's COVID brought in a lot of uncertainty to the economy, to the worldwide economy, and we did not know how were we going to be able to deal with this, how to cope with this, whether there will be a vaccine or anything. So businesses had to adapt. And right now we're seeing that we can probably be out of it faster than what a lot of people thought. So yes, it's that certainly will put some pressure into inflation, right? It will push prices up. And again, that's transitory. Yes, how long is transitory? Well, it's I agree with you, might be year and a half or something like that, but what I also tell people is, well, that's part of a healthy economy. Inflation, I say, as opposed to deflation, we would rather have inflation, but just a little bit, right? If it's too much, we had the issue that we're probably pushing demand too much, and we cannot catch up in terms of the economy, right? So yeah, that is an issue, and that is something we need to observe. But yeah, I mean, we're not gonna be like Venezuela, we're not gonna be like Argentina or those countries that have inflations that have been out of control. No way, right? And I don't know if you have anything to add to inflation, but I think this is a good segue to go to the next topic, which is interest rates. So the recipe, the textbook. Oh yeah, like the textbook example of, if you have high inflation, well, what should the central bank do? Increase interest rates, right? So right now we are in that dilemma, right? In that issue. Okay, if we have inflation, what we usually do is increase interest rates so that there's less money circulating in the economy, and therefore there is less pressure for prices to go up. And well, the Fed has been waiting on that, and yeah, should we expect that there's going to be an increase? What do you think, John? And
Yeah, no, I look, the Fed, I think, has been very accommodative in their monetary policy. I think they're trying to solve the employment issue, meaning trying to get these 9 million people back to work and reduce the rate below the current 5.9%. So I think what they're doing here is they're consciously accepting what they believe is transitory inflation. We're well above their target. Their target is 2%, and they look at this personal consumption expenditures index. We're running about almost twice that now. But again, the Fed is saying, hey, we're going to deal with this. We think it's just a temporary thing. We want to keep the accommodative policy going because we want to resolve the employment issue first. I think when you look at the futures market, if you look at the Fed funds futures, you look at the Eurodollar futures, they're forecasting basically stable rates until the end of 2022. That had been 2023 until the last 4 weeks, and it's moved up a year, but still another year and a half of stable rates is really what the futures are telling us. I think what the Fed will do first is, right now, they have this QE, quantitative easing, still in place. They're buying 120 billion of mortgage-backed securities and treasuries combined each month. I think what they would first do is to pull that back or reduce that, which would call a taper, a taper before a tighten. I would expect them to start to taper before the end of the year. I know right now there's a lot of discussion amongst the Fed members. Some of them think that they should be tapering now. Others don't think so. So I think that's kind of an ongoing dialogue, but I would look for them to taper before the end of the year, start to scale that back, because they've been basically doing this now for well over a year, and they're really growing the balance sheet of the Fed. And at some point, they either that has to come out, right? They have to allow those securities to mature and not to repurchase, or they need to go into the market and sell them.
Yeah, so the Fed is going to have to make a decision, and that will certainly affect all of us. We had a question here. It says, how can you be sure that the current inflation is transitory? And I think that is a great question that ties everything. Like okay, I just said it. We're not gonna be like Venezuela. Like how can we be so sure about that? How can we be sure about that?
That's a great question. I mean, first of all, the market is saying it is, right? So if you look at the 10-year Treasury, it's below 1.4%. So we actually have negative real rates here in the US. So if you look at the nominal rate that you can earn and you pull out the rate of inflation, which we said is running higher, it's actually negative rates, meaning you're not getting paid on these securities. And so the market is saying it's transitory, right? Otherwise, you'd see a 10-year yield, more than twice what it is today. So, we can't be for certain, but I think the market has many, many participants in it. And so I think what we're saying is the consensus is that it's transitory. It may not be. We'll just have to see.
Yeah, it's I like that word consensus, right? And let us not forget. I mean, we are what we say or what we think, it's based on what we see from the market, right? The market has many participants, and it's like, are they correct? Well, sometimes they're not, but they have skin in the game. The people that make decisions are people that are putting a lot of money in the market, right? So if they believe that rates are going to be stable, it's not only like my believe with my whole heart. No, they have millions and millions of dollars in the market that will be affected if that guess, if we may, is not correct. So people that have skin on the game, it's they're making that decision, right? So yeah, it's and that's why we believe it's transitory, because of that. It's now, do they have superior information than us? Well, we don't know, right? But we would like to think that they've done their due diligence, right? And certainly that is the case. And I mean, from what I've seen, from my experience in Latin American economies, I would say we're not even close to the problems that they've had, right? So that is my point with that. So anyway, it's going back to interest rates. We know that a lot of people right now are buying a house or buying cars or buying a lot of those things. And I always think, well, if interest rates are low, that usually pushes the prices of houses up. That because people have access to credit, and then they can pay larger amounts of money for a property and move in or whatnot. And then you get a big mortgage, and then you get a big payment every month. So should we? If we're buying a house, do you think the next year and a half will be the best time to do it? Should we wait? What's your take on that? And basically, I mean, are interest rates really going to go up?
I don't. So I think if you're given a choice between renting and buying a house, I would err on the side of buying the house, because mortgage rates are very, very low. I don't expect them, if the Fed is correct and that this inflation is transitory, we wouldn't expect those to rise dramatically. But again, the quantitative easing, of the $120 billion number I mentioned earlier, 80 billion of that is mortgage-backed securities, which the Fed has been buying each month. So that's keeping mortgage rates down low. So I don't think they're going to do that forever. So I think these mortgage rates are incredibly low. I think back, my first mortgage rate was over 9% in the late 80s. So I think it's a great time from that perspective. And I really don't see the housing prices in Nashville declining anytime soon, particularly when you have Oracle now coming here, and they're eventually going to put 8,500 people here. And then the healthcare, which is really what drives the Nashville economy, is just going to continue to expand and grow that industry as we all age and live longer.
Yep, that is correct completely. And yes, it's just be on the watch for that. Just be on the watch for that. So I think this is very important for us to consider, since interest rates affect all of us, right? That's our daily lives and whatever, all of the decisions that we make. But talking about decisions and daily life, let's move a little bit towards investors, right? So you and I, John, we're finance people, right? We like the market. We like to talk about the market, observe what's going on, and one of the key topics, or one of the main let's say drivers that we've seen in the market recently is retail investors, right? I mean, hopefully, well, I know you remember, hopefully the audience remembers that at the beginning, like several months ago, there was a big push with GameStop and AMC and other companies. So I would like to know what you think of that. The role of these smaller investors in the market. How do they affect what's going on? And what is their impact, right? I mean, it's on financial institutions, right? I mean, it's like, it's not one person with billions of dollars, it's millions of people with a little bit of money, so how does that affect me? What is your perspective on all that?
Well, I can tell you back over 35 years ago when I was in grad school pursuing an MBA. So I'm dating myself here. I remember sitting in my investment banking class and my professor basically saying, institutional investors are dominating the market. The role of the retail investor is swamped by these large institutions that are really controlling all of the trading volume on the exchange. And that's the way it was. And I tell you, the past year, we've come a long way in that
Oh,
there's
yeah.
a huge jump in retail trading volume in the equity markets. And I think, why is that? I think there's a couple of reasons. One is you've had these growth in these online brokerage platforms. So the Schwabs of the world, the Robinhoods of the world. And so what they've done is they've given retail investors easy access to trading. And not only are they giving them easy access to trading, it's very economical because they're trading for the most part at zero commissions. And we can talk about in a minute on why that's the case. But so you have folks getting very easy access. They've been stuck at home through the pandemic. And also Robinhood has, some of their experience has been compared to almost like a gaming experience. And so they've attracted a lot of young retail investors who are used to, basically playing video games. And so you've had all these things attracting and working to increase the retail investor in the markets. And so I think that's a good thing. I think it's a good thing that, to give people access to the markets. I think, though, there is a danger here. And the danger is that you have a lot of these folks with these momentum plays. So, Professor Rivas, you mentioned GameStop, you mentioned AMC. The GameStop market cap is right now over $12 billion. AMC is over $17 billion. These companies were almost out of business a year ago. Literally, they're on the verge of going Chapter 11. And if you look at the current Wall Street analysts, the projection of earnings of both of these companies, and the analyst estimates only go out for the next 2 years. They don't go up beyond that, but they have them both losing money. And so, we all know that eventually the stock price should represent the net present value of all the discounted future cash flows that a company will throw off. That's not the case with their current stock price. And so I think, the risk here is obviously there are investors that are going to get burned. And so that is definitely a downturn of what we're seeing here.
Yeah, it's to reinforce what you just said. I think you hit the point right there really, really well. It's good in a way that a lot of people have access to investing. I mean, this shouldn't be exclusive to just the ones that have millions and millions. Should be open to everyone. But education is very important. You need to know what you're getting into, and for example, Bitcoin. And we can talk about Bitcoin and other cryptocurrencies in a little while. But if we don't really know what Bitcoin is, well, it's hard to invest in that. It's now that you were mentioning GameStop, it's someone asked me, hey, is that a good investment? So I went to the Bloomberg terminal and look for their earnings per share, negative earnings.
Yeah.
So I will say, okay, does it make sense to you to pay $100 or whatever the price was, $100 for a company that is losing $2 per share? I mean, does that make sense to you to pay that much money to lose $2? Come on, I mean, you're losing money. Yeah. It makes no sense. So at some point, and this is what the theory says, and we have observed this many times. If the current price is way above what the price should be, there's gonna be a downturn, right? So prices, I think for those stocks that have been momentum, as you said, like attractive, and they're in the news and everyone talks about them in social media and discussion boards and whatnot, there's gonna be a time in which a lot of people are going to realize that they're paying too much money for it, and then the price is going to go down, right? So just be aware of that. And another thing that has been observed, it's this has happened. This usually happens. When prices go up, they go up. They can go up steady. They can go up at a certain consistent rhythm. When they go down, they usually go down very, very, very fast, right? They go down very fast. And here's one thing: if the prices have already gone down fast, that does not mean necessarily that they're gonna go back up, right? I mean, if a price goes down, you should not expect it to go back to 100, 200, or whatever amount you pay. That might be a loss that you're gonna have to take.
No, you're absolutely right. And the way I would sum this up is that the markets are efficient. And in the short term, there can be periods where there's inefficiencies, and I think you're seeing that with these stocks, and really they're being driven up by retail investors buying them with the hopes of selling them to somebody else at a higher price, and that's what we've been seeing here. But eventually, the markets, these efficiencies, it's an efficient market, and and these things are going to come back down.
Yes, and that's an important word, efficient. And a lot of people have argued, well, how can you say they're efficient? Well, I would say they're efficient in terms of the way in which they put information. The way information is incorporated to the market is relatively fast. So let's say, if you make an investment that is going to pay off in 10 years, well, the market takes that into account right now. They take the present value of that investment right now and say, okay, your stock should go up, your stock should go down. So yeah, that is how this works.
One thing I would like to add, and you'd ask, what is the impact of the increased retail volume on financial institutions? And we have this concept, payment for order flow. And so what's happening now is these online brokers, the Schwabs, the E-Trace or Robinhoods, they're actually receiving payments. In fact, in 2020, the top 7 brokers received about $2.6 billion in payments from trading firms to send their orders to the trading firms. So they're sending them to places like Citadel, Virtu, as opposed to sending them to an exchange. So these things are the trades are being executed off the exchange. And so I guess the question or the debate, is that a good or bad thing? And so first of all, it's the good part of this for the retail investors. That's what allows the online brokerage to charge them zero commission, because they're getting paid to direct the order flow. So that's what they're relying on for their revenues. And then the trading firms, the Citadels and those folks, basically what they're arguing is that they're actually executing these trades at price improvements. In other words, that price is better than what's on the exchange. And there's rules governing this as well. And they'll actually measure and quantify how much price improvement that their actions are taking in. So that's their kind of argument. There's others that basically say, yeah, but there's a lack of transparency when it's being traded off an exchange and things. But that's kind of a little bit of a new phenomena that we're seeing in recent years with this rise in retail trading volume as well.
Yeah, there were a lot of people that were not happy with Robinhood when all of this push from GameStop and other companies, because Robinhood was not able to process all of those trades, and part of that is that, I mean, they're not going to the stock exchange, they're going through a third party, and it is hard to process all the volume, and a lot of people were really, really mad about this, and they were blaming Robinhood and say, hey, you're not for the people or whatnot. But it's you need to have a broader understanding on how all of this works, And I always say, if you're investing, try to think of the long run. Try to think of how much money are you going to make in the long run. Now, yes, you can invest for the short run and to make profits in a day or whatnot, but there are also risks involved, so just be aware of the risks.
Absolutely.
Yeah, but I think this Robinhood, I would say Robinhood to talk about the online trading platforms, they have revolutionized the way in which people see the market, right? I'm gonna give you an example. It's yesterday I was talking to one of my colleagues here, and her daughter, 10-year-old daughter. It's now she has an account. Obviously her mother manages the account, from what I understand. But the 10-year-old daughter, she's looking at companies to invest. And she's trying to read. How how positive and what should you do so that you can invest. I said, well, this is a great exercise. I mean, when I was 10, I never thought about investing, right? And now she's 10 and she's reading, and then they told me, well, I invested in Tesla and Home Depot. I said, well, that's great. I mean, one, I don't know whether they were thinking about diversifying, but say, well, one is growth, one is technology, the other one is more value, more stable. So I think you did a very good job. So hopefully all of this brings in a new generation of investors that are more aware on how the market works and do their due diligence, right?
Absolutely. Yep.
Yeah. So along those lines, it's how do you think this or what's going to happen in the future with retail investors? Should we expect to see more 10-year-olds investing in the market, or how is this going to turn out? What do you think?
I think they're here to stay. And again, I think that's overall, I think it's a good thing. I think by giving folks access through these platforms, relatively easy to use platforms, connectivity, it'll be here to stay. And again, there's going to be definitely some fallout along the way, particularly from the folks that are playing, these me stocks. And if they're not investing and doing the correct fundamental analysis, they'll get burned. But I think it's here to stay overall.
Yes, and just be careful. I mean, that's the only thing we're asking you to do. It's if there's a meme on the internet, that does not necessarily mean that's a good company, right? I mean, so just do a little bit more research. Now, along those lines, and for the audience, you feel free to ask us questions. I mean, we're in relatively soon. We're gonna start our Q&A session. So if you have questions, feel free to put them in the chat. In the section for Q&A, and we will address them once we're done with the topics that we have here. But for right now, what's gonna happen with the market? Should we expect the market to keep on going up? Should we expect a collapse? What do you think?
Sure. Well, first, I mean, let's think about different markets. So start with the fixed income market. And the fixed income market, the last 10 years, it's been a great place to be. Rates have come down. Folks have done very well being long bonds the last 10 years. I think that trade's over with. When you look at where interest rates are currently, and we talked about, you look at the treasuries, we're kind of in a negative real interest rate type of environment. If you look at corporate credit spreads, extremely tight. And so I really think at this point, the place to be is not in bonds. And I think, why is that, by the way? Why are rates so low? Why are spreads so tight? Well, it's because the market's showing confidence in the Fed. And by the way, I think the Fed has done an incredible job here. I think Chairman Powell, through the two different administrations, through the pandemic, he's really kind of, stayed very, to his views, and stayed to the course that he laid out, a year and a half ago. And so I think, and the market, I think, is showing confidence in that otherwise you'd have what we call these bond vigilantes, by the way, which I don't know if many folks on the call have heard of this, but if you go back to the 80s, that was a very common term. It was coined by Edward Yardeni, who's a Wall Street economist. But it's the bond vigilantes would be looking at this saying, hey, we don't believe the Fed. We don't have confidence in the Fed. Rates are too low. We're going to sell bonds here so that when the prices go down, we're going to profit. You don't see that happening now, right? There's no bond vigilantes out there. So the market's very confident, I think, in what the Fed's doing. So I think the fixed income trade, I think, is done with for now. And so I think the only place to be then is equities. And I think what's happening here is, sure, equities have gone up a lot. They were up 16%, I think, for the first 6 months of the year, the S&P. But what you're seeing though is the economy is cranking along. I mean, we're over 6% GDP growth in the first quarter. The second quarter right now, the forecasts are for over 9%. That would put the full year right now, we're looking at a year that we haven't had since the 80s as far as strength of the economy. And so I think, these corporate profits will continue to expand to justify the valuations that we're seeing in the market. So I think if we're looking at over the next, year to 2 years, equities is the place to be.
Yeah, I think. Sorry. Please go ahead.
I'll say, how about yourself?
No, I agree with that completely. And it's I was in a meeting, I was in a call a couple of months ago with some people that do financial planning, and they were saying that they're going to shift the portfolio away from bonds because of that. And one of the things is there is this basic principle that says if rates go up, bond prices go down, right? So, and if bond prices go down, your bond returns will go down. So if or when rates go up, you should expect your bonds to go. No, when rates go up, you should expect the price of your bonds to go down. That will happen at some point, right? I mean, we're saying that that's going to happen. So I agree with you. I mean, equities is the place to be. Now, is it all, are all stocks good? Well, I guess it all depends, right? I mean, it's some people like to invest, in index funds, something that mimics the S&P 500, the Dow Jones. I mean, I think those are good investment, relatively safe, and gives you a good return. You can also do research about different companies, right? And what you were saying, it's very important, right? Some of them have very profitable projects in mind, right? So when you're investing, think of what's going to happen in the future. How do you visualize that those investments from those companies are going to turn out? And that is the key. I mean, if a company is smart and wise and does the right things, chances are that the stock price is going to go up. And if you bought their stock, you're going to be making some profits, right? Mm-hmm. I remember when I was teaching in Texas, when I was studying my Ph.D, we were having a stock market game, so we were playing, like a fake stock market. Well, it was actual real stock market data, but fake money. So I remember checking the group's portfolio, I mean, individual portfolios one day, and suddenly I had 3-4 students that had like an outstanding return. Say, oh my goodness, what happened? Well, Apple had their earnings call. So they invested in Apple before that because they thought that their earnings were going to be positive. And they turned out that they were, there was a positive surprise and the price of the stock jumped. So hey, they timed this in a way in which they thought it was going to work, and it worked for them. So I guess what I'm trying to say is take advantage of all the information you have and think of the long run.
Agreed.
Yeah. So let me see. We have a question right here. I'm looking at the question, so just give me a minute. Okay. Do you have anything else to say? Because questions are starting to pour in, and we might take a little while in answering those questions.
Sure, let's go to the questions.
Yeah. Okay. So let me give you this question. By Kevin Monroe. So Kevin is asking, okay, our national debt is persistently surpassing some $27 trillion. What is your view as to sustainability dealing with that debt load in the medium and long term, particularly if interest rates do eventually go up? Will the Fed eventually be compelled to monetize debt, contributing to an even greater inflationary potential? So that is the question, right? And we have $27 trillion of debt, so what's up with that? Like elephant in the room, right?
Yeah, no, Kevin, that's a great question. I think what's happening is, it just keeps getting the can keeps getting kicked down the road. It keeps getting kicked down the road from administration to administration, and from the Fed to the next Fed. And so eventually the music will have to be faced. And I agree with you. If the adverse situation could result here is extremely high interest rates, inflation, and as this thing continues to increase and eventually spiral out of control. So eventually it has to be addressed. And I think that's to put this into kind of the discussions that are happening today in Washington, it's the same thing, the debate between the Republicans and the Democrats over whether or not we're going to have a $3 trillion infrastructure bill. And so it really kind of comes down to that question in the short term. Is $3 trillion too much? The Republicans will say yes, and the Democrats will say no. So unfortunately, I don't have an easy answer here. I'm not very optimistic that this situation gets resolved really anytime soon, particularly when I see the discussions that are happening in Washington now, and the lack of agreement or folks willing to stand up and kind of own the deficit.
Yeah, it's unfortunately, some actions might be taken once it's too late, so it's hopefully we will not reach that point, but yes, that is the question, and that is an issue, right? So we have another question here. It's what kind of economic impact will we see as more companies embrace work from home long term? So working from home,
So I think there's going to be a reset in terms of the commercial real estate market. So because as more and more companies embrace this, the demand for office space is going to will decline. And I look at places like New York City, where historically employees have had very long commutes in New York City, and so when you get to these major cities like that, Los Angeles, San Francisco, those employees are pushing back, right? And they want this more flexible arrangement going forward. And so if that means if they're going to only come into the office half the amount of time than they've done before, then the firm eventually will need only half the office space. And so I think what we'll see is eventually a repricing down of office space. And I think firms are going to be are going to get pulled this way. You hear JP Morgan, Goldman Sachs, they're saying no flexibility. You have to be in the office. You have other firms like Citibank and UBS saying, hey, we're going to be flexible. And so what's eventually going to happen is that the ones that aren't flexible are going to lose employees to the ones that are. And I think eventually the ones that say they're not flexible today are going to have to become flexible in the future. It's going to become a recruiting tool. So I really think that you're going to see more and more flexible arrangements, work from home. I know Alliance Bernstein here in Nashville is going to, for the most part, to basically 2 days a week flexibility. So you can, work from home 2 days a week. They're going to flexible hours as well. So they're basically saying, hey, you have to put in 8 hours anytime within the time frame from 7 in the morning to 7 at night. So if you're going to come into the office, you don't want to deal with the traffic, come in at 10 o'clock and work, 10 to 6 instead of 8 to 4 or something like that. So I think you're going to see more and more companies doing that.
Yeah, that's a very interesting trend, and I would say thanks to COVID, we have that trend, but that certainly gives a lot of flexibility to people that work, commute times. Even here in Nashville, a lot of people have very long commute times and traffic and whatnot. Well, New York City, you experience that, in your own person, so having that option would certainly be positive. And yes, I think that's going to be used as a recruiting tool for many companies. It's if so-and-so company wants you in the office, and so you can work from home. Well, you might want to work from home instead of going to an office. So that is what it's happens. So John Toker, when you were overseeing the move from your city to Nashville with AB, how much did the infrastructure or public transit plans impact the number of employees that made the move? With the housing market the way it is and the lack of public transit available to mid-level employees to make becoming a homeowner affordable and the commute reasonable. When you speak of Oracle moving 8,500 jobs, what will they be doing between now and then to encourage employees to relocate and to attract and retain talent in such a hot job market? So I think that's a great question. We're relocating to Nashville, but then we have that. How can you make it attractive? Like in your case, AB. How did that happen?
So what we saw when we picked Nashville, what we saw for our employees was a better quality of life, and the commute times, I'll talk about this in a minute, but they are shorter than what they are back in New York. Also, the tax situation is better as far as not having the state income tax. And
the city income tax, right, for some people, right?
Right. And the housing market, believe it or not, is, even though it's tight here, it's still in a much better place as far as more house for your money than what you would get up in the Northeast. So it kind of checked all of those, and the weather's better, by the way, as well. So that was another factor as well. So all these things went into it. From a commute perspective, when I worked in New York, and I did this for 35 years, I commuted over 3.5 hours round trip a day for 35 years. And so, when I came here, my commute came down to round trip 40 minutes a day, and then it became basically zero, with the pandemic. So even folks that live out in Franklin, and many of our young folks do that because they wanted the school districts out there and commute downtown. It's still much better than the commutes they had when they were back east, as well as now moving to the flexible work hours and also the flexible work arrangements where you don't have to be in the office every day is going to help tremendously as well. I think the whole issue though is obviously the city, and I sit on the Nashville Downtown Partnership, which is the non-for-profit that is looking at downtown Nashville and trying to make it the best place to work, live, and play. And they're very much concerned about the whole infrastructure of the city and the transit plans and things like that. I think eventually the city has to do something about it, right? Because it's just as more and more companies move here and more people move here, it just results in more and more traffic and congestion. So in terms of looking at things like public transportation, I think eventually is a must, because otherwise Nashville risks becoming another Atlanta or Austin on a smaller scale too. Austin has huge traffic issues now and really kind of lack of major public transportation.
Yeah, no, that's you bring some very, very good points. I'm gonna ask the next question. Porter Kennedy, how do you use the crypto markets? How do you see, the crypto markets playing out over the next few years?
Okay, I'll give you my view, and then I'd be interested in hearing Professor Rivas on this one. I think that this is a situation where I want to be a late adopter. I don't want to be an early adopter of this. I still scratch my head on this, to be honest with you. To think about where currencies are created by solving mathematical algorithms, and there's several of them. I'm not quite sure I get it, that I understand it, and how it competes with real hard currency, where you look at different countries and you can understand, why the yen is trading where it is versus the dollar. Because if you look at the different interest rate policies and levels where they are in the different countries and the fiscal policies, you can actually, through interest rate parity, you can actually get there and understand it, and understand that there's banks, central banks behind these currencies. The whole crypto thing, this is a situation where I'm on the sidelines here just watching.
Yeah, it's going to be interesting. I mean, we theoretically say that currency has three functions, like means of exchange. I give you money, you give me a product, also to count, so, okay, you owe me this many dollars, and also a store of value. right? So if I put my money in dollars, it will keep its value minus inflation, right? I don't see cryptocurrencies doing any of that. I mean, I remember, I think Tesla was the one that was starting to accept Bitcoin, and then they didn't, and then they might, but I don't think they price their products in Bitcoin. They just price it in dollars and do the exchange into Bitcoin, right? So that is the thing, and I'm with you in the sense that, well, I don't really know what's the underlying asset, right? I don't really know what people are paying to own Bitcoin right now. Full disclosure, I have a little bit of Bitcoin. Right? I just, same reason, just to have a skin in the game, just to have a dog in the fight. I bought a little bit of Bitcoin, and it's been a wild ride. I mean, I when I did this, I told my wife, this is more of a pedagogical experiment rather than really investing. I would say it will be interesting to see how this moves. I mean, I'm not saying this is gonna be a fad and gonna die. I mean, I've seen a lot of people. I went to a seminar with the guys that run Bitcoin Magazine, and they're younger. I mean, they're 10 years younger than me, and they're really into the market and really analyzing. So I would say, if you're interested, do your research, and see about all that. And for some of us, we are a little skeptical right now, but nothing, that doesn't mean that is gonna, that is something that is not gonna be working. We just need to see. Brian, with inflation increasing at high amounts of and the high amounts of jobs being available, which industries are being affected the most by this, and when will these industries bounce back? And which industries are thriving in these conditions? So right now, which are the good industries and which one are the bad industries?
Well, I mean, we spoke a little bit about this earlier, but it's in the hospitality industry. So whether it's hotels or it's, it's the restaurants and the bars, there's a huge shortage of workers right now. And I think what's happened is a lot of these folks were laid off during the pandemic because this was the sector of the economy that was hit the worst. And they're very slow to come back. And they're slow to come back because they've found other jobs in other industries. And now some of the hotels and the restaurants, they're having to offer increased compensation to get people back and to get them to work. So I think that's kind of where it's falling out right now.
Yeah, it is. I tell you, I mean, it's some of these industries are really struggling to get people, and it is kind of a contradiction that there's a lot of unemployment, but then there's a lot of jobs. So, but this is something that hopefully will be sorted out soon, and well, that's the way the economy works. It's people will get a job that will basically be good for them. Jonathan, how do you think the child tax credit will affect the economy? I'm cynical. I don't think most people will spend it over their children.
I would agree with you with that as well. I think, it's just, unfortunately, a lot of times the fiscal policy, they're enacted for certain reasons. In this case, child care tax credit uses to take care of your child, but many times the recipient uses it for something else. And I think we saw this during the pandemic with some of the, the payroll, the PPP loans and things like that, the different stimulus payments that went out to individuals, and a lot of them actually used it to trade online and to buy GameStop and AMC. So,
yeah, I agree with that. It's though policies and though what the government or whoever it is has a noble good purpose, people are gonna do whatever they think it's best for them.
Mm-hmm.
And there's always gonna be that difference. Jared Peters, right now ECR and interest rates are at historic lows. Many interest rates are at 1 BPS for any excess balances or savings account. Do you have any observations or expectations on when interest rates will start rising on deposits for business and individuals? I've heard late 2022 or 2023.
Yep, no, I agree with that. And I think, as I mentioned earlier, that's what the futures markets are telling us. When you look at the Fed funds futures and Eurodollar futures, they're basically forecasting stable rates for the next year and a half. And as Professor Rivas said earlier, the markets are the best information we have in terms of a view, because it's the consensus view. There's so many players in there. They have their money at risk, their skin in the game. So I think your forecast is kind of right in line with what the market is saying.
Yeah, and that difference of 1 basis point, right? 0.01% difference between one account and the other. That's a very tight market. That's a very tight, and well, that certainly might change, or we should expect it to change later. Later in and by later in year and a half, at least year and a half. So based on market projections, how high is the opportunity for individuals who have recently graduated college and still in college getting ready to graduate?
I assume to get an employment.
I would say so. Yes, that's
so.
Probably not.
I can tell you, I had my younger daughter graduated school a year ago. So right in kind of the middle of the pandemic. Fortunately, she had a job and is still in that job. Many of her friends, it took them at least 6 to 8 months to find employment. I think the situation is obviously better now. With the class that just graduated, and particularly it's improved a lot in the last 3 months or so, as people have gotten vaccinated and things has reopened. So I think it's much better now than what it was a year ago. Probably not as great as maybe where it was 2 years ago, but I think it's rapidly improving.
Yeah, I think there are options, and it's some jobs, some industries will be in more demand than others, and just be aware of that, and if you want to study more, feel free to join the MBA program at Lipscomb. Shoot me an email and I'll be happy to give you more information, right? Or to be happy to connect you with the right people. So anyway, John, that was the last question. Do you have anything else to say before we wrap up?
Thank you very much. It's been a pleasure participating today. Thank you very much for all the questions. I look forward to meeting many of you and seeing you on campus in the fall.